What's going on, guys? Today we are going to go over some of the interesting news that's kind of came out today about the stock market, about interest rates, about the Federal Reserve, and kind of everything that's going on with that. So I hope you enjoyed the video. If you do, make sure you drop a like down below. And if you want to see more videos like this one, make sure you hit the subscribe button. So I want to start off by looking at SPY. Obviously, if you're looking at the stock market at all today, it kind of things started off looking just about average. Like we're going to have a small down day like we've kind of had over the last few months, where we'll have either a big up day and then a big down day, and then kind of just these little bleed off days where we'll lose like a 0.5% or something. But what ended up happening is, right, the Federal Reserve had their meeting today, and basically after that, everything just tanked off a cliff. So you're seeing that even the week was basically flat or the last 5 days, I guess, until this meeting. So everyone kind of was in anticipation of what's the Federal Reserve going to say when these notes come out, and where's everything kind of lining up. So basically a lot of bad news came out with that. But before we get into that, I wanted to look at some of the stocks that I had mentioned in my video on Sunday. So on Sunday I had mentioned SoFi Technologies. So I talked about basically selling puts under it, running the wheel on it, and SoFi today was down 6.3%. And then Robinhood was the other kind of big one that I was kind of looking at and talking about, and that one is actually down 8.16%. So I have puts existing on these. What I'm thinking about doing right now, just to keep you guys kind of up to date, is basically rolling those out. So if you haven't seen my video, I have a video on a SoFi call that I've rolled. You can do the same thing with puts. I potentially will make a video if kind of things play out the way I'm thinking they will. I'll probably make a video this Sunday going over kind of how I execute and kind of fix these trades. All right, so here we have a good article from CNBC that outlines really what the Fed kind of discussed today and why it's important. So the first thing kind of that I highlighted up in here is just basically what we're looking at. So the S&P 500 dropped 1.94%, and the NASDAQ actually dropped almost double that at 3.34%. So NASDAQ, there's just been a lot of rotation to tech. You've seen a lot of people kind of put their money in a lot of the bigger tech stocks like Apple, Amazon, Google, Microsoft, because they kind of feel like they're safe right now, but they're sitting very high. So you've seen a lot of basically money rotate out of those very kind of quote unquote safe large cap stocks, and that's kind of what's resulted in a lot of these kind of downturns in here. But what's really interesting is what's said here. So almost all participants agreed that it would likely, and this is talking about the Fed meeting, all the people that participate in the meeting. So all the participants agreed that it would likely be appropriate to initiate balance sheet runoff at some point after the first increase in target range for the federal funds rate. Basically what they're talking about, that's kind of overly complicated. Balance sheet runoff is the huge point to basically look at here and focus on. What they're talking about is that the federal, basically the Federal Reserve, right, they're looking at increasing interest rates, which everyone has known for a long time. So a lot of that has been, for the most part, priced into the market. But what's different with this statement is they're talking now about balance sheet runoff, which balance sheet runoff, after kind of doing some research and looking into it myself, basically what they're talking about is right now and over the last kind of few years, right, ever since 2020, the Federal Reserve has been buying assets. So they have been buying corporate bonds, they've been buying stocks, they've been buying basically anything that they can get their hands onto, just to drive, basically keep the market stable. So what's happening though is they're talking about running off their balance sheet, which basically means getting rid of these assets that they're holding, basically reducing their balance sheet. So that's huge because, right, you have the Federal Reserve, who has dumped millions and billions and potentially even trillions of dollars into not only the economy through basically providing Americans with stimulus checks and other things, but also directly through buying assets. And now what they're talking about doing is basically selling those assets, right? So here they talk about, right, the runoff is the key factor, and then basically they're not injecting liquidity like they've been doing the last few years. They're actually taking liquidity out of the market. So they are selling actually portions of their position. It would be like a hedge fund, right? Coming into a stock and then selling out a large portion. They basically equate it to Warren Buffett selling out of Coke here. So Coca-Cola. So if Warren Buffett, right, sold out of Coca-Cola, right, that stock is going to plunge because he has a large portion of the shares. I forget what percentage exactly he owns, but I know he doesn't own over 10% because you have to basically start reporting it to the SEC if you do and become more involved in the company. But he owns somewhere around 7%, I think it is. And at that point, right, when such a big investor is selling out of the company, it's going to affect the stock price. So as you're kind of seeing, right, this is the initial reaction. I doubt the Fed has actually sold anything, right? Like they said, they want the rates, they want to increase the rates, kind of see how that affects things. But then the fact that they're even considering basically selling these assets, it's scaring a lot of investors. And rightfully so, because like I said, they own a large portion of shares in probably some companies. I would guess that they own basically broader markets as well as a lot of larger cap stocks like the Apples, Amazons. So I think what you could see over the next kind of probably year is really the time frame that we're looking at, because they'll want time to kind of look at how raising the interest rates kind of affects the overall market. But they'll probably start selling out of those larger positions, and you can see a lot of these large cap stocks kind of start falling back to earth. A lot of their PE ratios are kind of blown out of proportion right now. They're much higher than they have been over the last kind of 5 years. So Apple is a great example of that. It's much higher, has a much higher PE ratio than it kind of had over the last 5 to 10 years. So really, you could see a lot of those stocks kind of fall back down, and Apple could fall quite a bit kind of into a more reasonable valuation. The question will be, right, is a lot of these stocks have a lot of buyback programs. So if Apple or Amazon or Google or Microsoft, if they're buying back their shares at a reasonably kind of high rate that the Fed is selling them off, you could see a very sideways market. So I think there's a kind of a lot of question marks in the air right now, because you could see both sides of it, right? You could see them buy back, you could see things kind of stay flat, or if they actually see interest rates going up and they don't want to spend that money because they're worried about interest rates and basically, right, you don't want to hold on to debt in higher interest rate markets, where in low interest rate markets, you're fine with taking on more debt. If a lot of these companies kind of see that and actually reduce their buybacks, it could basically negatively affect the stock price, and you could see stocks, a lot of these large caps, drop off quite a bit. So the best way to look at this is, let's look at the past and what has happened in the past. Obviously, it's not indicative of future results, but that's really the only thing you can do to at least get an idea of what could happen and kind of just make estimates and make kind of your predictions based off that. So this is a very good article by Goldman Sachs, and basically they talk about the runoff that was kind of experienced so obviously in 2008 there was a huge obviously financial crisis, and from that the Federal Reserve reacted in a similar way by buying a lot of assets, putting a lot of money back into the market, just trying to get consumer confidence back up. So part of that is on the back end, they obviously needed to run down their balance sheet, right? Get a lot of these assets off of their balance sheet. So that took a while to kind of get to that point, but in 2016, you could see they started talking about it once they had increased interest rates. So they made some rate hikes, and then basically in 2017, September of 2017, the runoff actually officially they announced the official runoff starting. So it didn't start for a month, and that's why it says actually in October they started running off some of their balance sheet. And what they ended up doing, what you kind of see here, is they were running off $10 billion a month and basically gradually increased it until they hit $50 billion a month, and then over time kind of stuck at that mark until eventually they kind of said, okay, things are getting better, they're turning around how we kind of want them to, and then they started backing off. to a more normal rate, basically. So this is a very interesting kind of thing to look at, but what we need to do is we need to look at kind of how this matches up with the market. So what we have here, I just want to bounce up and look at this. So in September, they started the runoff effective the next month, so that would be September of 2017. So what we're looking at is kind of the market right in here. So you can see the market kind of, it looks like almost reacted negatively, kind of right in this small, you can kind of see it once I move my cursor out of the way. There's a little dip there, and then it actually bounced and kept running up, which is very interesting. It's kind of, I'm not sure exactly why that would have happened, but obviously the market kind of still had a positive response to either how the economy was setting up. But what is very interesting is in here. So this is the start of 2018. And if we jump back over here, in 2018, the pace of runoffs gradually rose from 10 billion all the way up to 50 billion per month. So what you're seeing in here, right, is everything is increasing. Let me actually jump back over here. So they have a timeline down in here. So January, you see they really started basically ramping things up, 30 billion, 40 billion, 50 billion, and they continued that over kind of a stretch of time. So if we look kind of right in here, that's July to October, you're actually seeing them hit that 50 billion mark. So July of 2018, you're kind of somewhere in here-ish. So you see kind of things running off again. And basically there's a lot of volatility in here. And here, the back half of 2018, we also had obviously the kind of the issues with the China trade war. So you can see there's just generally a lot of volatility in here. But the biggest kind of concern is, right, as they started ramping up their runoffs, a lot of the market kind of was affected in a negative way. But overall, we still saw a trend, a general upward trend, right? If you started investing, right, even as that dip probably occurred, as the market announced, or as the Fed announced that they were going to start runoffs, you would still have been up at the end of 2018, which is about when they started, July of 2019 is when they stopped their, July of 2019, let's find it on here, right here. So you're significantly above where you were at when they first announced the runoff. So overall, right, the market, I think, still has the potential to go up, but there's also, I think, going to be some periods of sideways movement coupled with a lot of volatility. I think now will be a lot of good, there will be a lot of opportunities not only to trade options, but also to buy into a lot of good companies at very low prices, right? Like I said, I think Apple and a lot of big tech companies will be affected negatively, and you're kind of gonna, you have to see that to really have the market have this much move, because the market is very top heavy right now. But overall, I think there's going to be just kind of a lot of volatility, a lot of sideways movement, but there's still the possibility that over time, right, I think we're always going to kind of trend up. That's generally what you've seen from the stock market over its kind of entire lifespan. I mean, if you look at any amount of time, we've seen things go up. So long-term hold, kind of stay true with what you're doing. If you're making any options play, just make sure that you kind of have a way out, that you know how to manage your trades, anything like that. But otherwise, I hope you guys enjoyed the video. If you have any questions or comments on any of the things kind of mentioned today, just leave a comment down below. If you like the video, make sure you drop a like down below, and make sure you hit the subscribe button if you want to see more videos like this. Otherwise, have a wonderful rest of your day.